You ever look at a $20 burger on a menu and think, man, somebody must be making a killing? Well, what if I told you that expensive burger is actually part of a story that's causing some of the biggest companies on earth to lose hundreds of millions of dollars? It's a huge paradox happening right now. So where's all that money actually going? The answer is not where you think.
It really all starts with this number, $6.75. That's the new record high price for a single pound of ground beef. And look, you've probably felt this yourself at the grocery store. It's that sticker shock that's actually a signal of a much, much bigger story playing out behind the scenes.
And yeah, this brings us to the big question, right? If prices are through the roof, someone's got to be getting rich. Is it the ranchers? The restaurants? I mean, it seems like common sense, but the really shocking answer is almost nobody is. And that's the puzzle we're going to piece together today.
To figure this out, we've got to look way past the price on the menu and go all the way back to the fields. Because what's happening isn't just a simple case of corporate greed. Nope, this is a historic supply crisis that's been building for years.
And this number right here, this number tells you pretty much everything you need to know, 86.2 million. That's how many cattle are in the U.S. herd right now. That is the smallest it has been in 75 years. Think about that, all the way back to just after World War II. It's simple math. Fewer cattle means less beef, and that scarcity, that's the engine driving this entire thing.
And here's the kicker. You can't just flip a switch and fix this. You can't build a cow in a factory. This timeline lays out the brutal reality. The herd is still shrinking, thanks to things like drought and crazy high feed costs. We probably won't even see the herd start to recover until 2028, at the absolute earliest. So yeah, we are in this for the long haul.
So how does a supply problem in a field turn into a financial problem for businesses? Well, it creates this massive tug-of-war for everybody, between the farm and your dinner plate. It's a phenomenon called the Great Margin Squeeze. So what is a margin squeeze? It's actually a pretty simple but brutal concept. Imagine your costs are just skyrocketing, right? But you can't raise your own prices fast enough to keep up, because if you do, your customers will just walk away. So your profit margin gets squeezed and squeezed until there's nothing left. Or even worse, it becomes a loss.
And boom, this chart shows you that squeeze in action. Just since 2023, the cost for a restaurant to buy beef has shot up 32%. But look at that other bar. They've only been able to pass on a 14% price increase to us on the menu. That huge gap between those two bars, that is where profits go to die. It's called menu lag, and it is absolutely destroying businesses like steakhouses.
And if you need some cold, hard proof, well, here it is in black and red. Negative $319 million. That was the operating loss for Tyson Foods, one of the biggest meat processors on the planet, in their beef division. And that's just for one quarter. They were literally losing a fortune on every pound of beef they sell.
So you might be asking, why don't they just raise the menu prices more? Because of you and me. It's totally predictable human behavior. When things get too expensive, we trade down. You stop buying that fancy $5 coffee and you start brewing it at home. And when steak starts to feel like a luxury, you start looking at the chicken sandwich. And this is where the story takes a huge turn. Because a crisis in the beef market is creating a massive, massive opportunity somewhere else. This is what we're calling the Great Chicken Pivot. Now, this isn't just some random trend. It's a classic economic move called protein substitution. It's super simple. When one protein gets too expensive for most people, demand just naturally shifts over to the more affordable option. And in the market today, there is one very clear, very obvious alternative: chicken.
Let's just break down why. Beef is like a slow-moving cargo ship. It has a long, expensive production cycle. We're talking years to raise a single cow. Chicken, on the other hand, is like a speedboat. It's fast, it's efficient. You can go from an egg to the market in just a matter of weeks. That makes the entire chicken industry way more agile and way more profitable when people are pinching pennies.
So what does this look like for an investor? It reminds me of that classic Cisco versus Cisco story from the dot-com bust. Everybody wanted the sexy tech stock Cisco, but the real boring profits were being made by Cisco, the company delivering all the food. It's the same thing here. Everybody sees the flashy steakhouse, but the real money is being made by the quiet poultry producers powering the whole trade.
Okay, so let's get down to it. How do you actually think about this as a trade? If the whole market is pivoting from beef to chicken, which companies are set up to win from this massive shift?
Well, there are two really interesting ways to play this. You could go with the huge industrial giant that's kind of hedged. It profits from chicken even while its beef business is struggling. Or you could bet on the specialized consumer brand that seems like it was built for this exact moment.
So let's look at Tyson first. We just talked about them hemorrhaging cash in their beef division, right? But this chart shows you why the company as a whole is so resilient. That red slice is just one part of the story. Their chicken and prepared foods divisions are enormous and, more importantly, very profitable. So a bet on Tyson is really an industrial agriculture play. It's a bet that their winning chicken segment will more than cover the losses from their struggling beef segment.
And then you've got the pure play winner, Wingstop. Man, this company is like a fortress right now. First, their main cost, chicken, is stable and affordable. That gives them a huge structural advantage over anyone selling burgers. Second, their franchise model is asset-light, which protects them from inflation. They just collect high-margin royalties. And finally, their operations are so efficient that analysts have called them a tech company that just happens to sell chicken. It is a powerful, powerful combination.
So what's the big takeaway from all this? Really, it's about learning to spot and avoid the common traps that people fall into when they just read the headlines about high beef prices. There are a few big ones. First mistake is buying steakhouse stocks. You see high prices and think high profits, but you forget about menu lag. They just can't keep up with costs. The second mistake is buying the beef producers themselves. Yeah, prices are high, but a shortage means they have less stuff to sell, and that crushes their revenue. The key is to always look past the headlines and think about the second-order effects, like the completely logical rotation into chicken. Ultimately, if you remember just one thing from this entire explainer, let it be this. The sticker price you see on the shelf or on the menu, that's just the tip of the iceberg. The real story, the one with all the risks and all the opportunities, is always happening deeper down in the supply chain.
So keep this framework in your head. A big price shock in one area almost always forces consumers to trade down to something more affordable. The beef to chicken pivot is a perfect real-time example of this in action. The question you should be asking yourself now is, where is the next great consumer trade down going to happen?